We need to start today with just a single number, 9.2.
Right.
That is the current reading on Goldman Sachs's Panic Index. And if you're familiar with how this index works, you know that anything above 9 isn't just a warning light.
It's a full-blown siren.
It is effectively screaming max fear.
We aren't talking about a mild correction or a bad afternoon on the trading floor here.
Not at all.
We're looking at a structural collision course that is already in motion.
That's right. It is the red light on the dashboard that everyone, tries to ignore until the engine starts smoking. And what makes this terrifying isn't just the sentiment, it's the mechanics.
The mechanics?
We have fresh market intelligence confirming that roughly $33 billion in U.S. stocks are projected to be sold this week by algorithmic funds.
Okay, hold on. I want to pause you right there because that is a massive claim. $33 billion is leaving the market no matter what.
We're used to thinking, okay, if the news is good, stocks go up. If it's bad, they go down. But you're saying these machines, these algorithms, are locked in.
They're locked in. This is what people really need to understand about the modern market.
Yeah.
We aren't just dealing with humans making decisions based on, how they feel about the economy.
Sure.
We're dealing with CTAs, commodity trading advisors, and these trend-following funds. They run on math, not optimism.
Right.
And right now, the math is telling them to exit long positions to manage their risk. So we have $33 billion heading for the door. But, and this is the critical but,
There's always a but.
if the S&P 500 dips below a specific floor, which the data identifies as 6,770,
6770. Okay.
that sell-off number doesn't just stay at $33 billion. It balloons to nearly $80 billion.
80 billion. I mean, that is not a correction. That's a liquidation event.
It's a cascade.
Yeah.
And to give you some context on why that 9.22 panic index level matters, the last time we saw ratings this high, it was right before the significant pullbacks we saw in October and November.
Right. I remember that.
And even more concerning, it matches the levels we saw right before the Liberation Day crash, where the market fell 21%.
21%. That sounds apocalyptic. But let me play devil's advocate for a second. We've heard doom and gloom predictions before that didn't materialize.
Of course.
The market's resilient. What makes this specific setup different from just a standard dip where people, buy the bottom?
The difference is the leverage and the automation. When you have a panic index at 9.2, it means the market is incredibly fragile. It's like a rubber band stretched to its absolute limit. It doesn't take a hammer to snap it, it just takes a pinprick. The machines are positioned for a cliff edge. They react to price direction. So if the market starts to slip, the algorithms sell.
Which makes the market slip more.
Which triggers more selling. It is a self-fulfilling prophecy written in code.
So we have the machines ready to hit the sell button. That's the technical side, the plumbing of the market. But usually these algorithms are reacting to something.
Right.
You don't get a max fear reading just because the math feels like it. What is the fundamental rot here? Because when I look at the headlines, I see the Dow hitting all-time highs.
Yeah.
I see people going out to dinner, full flights. What are we missing?
You are seeing the paint job, not the engine. If we pivot from the stock market to the real economy, the U.S. consumer, the data is, frankly, shocking. We're looking at a consumer that isn't just bending, they are breaking.
Okay, let's unpack this. Because the narrative for the last 2 years has been the resilient consumer. Don't bet against the American shopper. Are you saying that narrative is dead?
It is dead in the water. Look at the latest delinquency data coming out of the credit bureaus.
Yeah.
U.S. loan delinquencies have hit 4.8% of household debt.
Wow.
That is a near-decade high, the highest level since 2017.
Oh.
But if you drill down into who is defaulting and what they are defaulting on, it gets much darker.
I saw the credit card numbers in the latest reports, and I honestly thought it was a typo.
It's not a typo. The share of credit card loans that are at least 90 days delinquent.
So people who haven't paid a dime in 3 months.
Exactly. That number has hit nearly 13%, 12.7% to be exact. We haven't seen a number that high since early 2011.
Think about that context for a second. 2011, we were still crawling out of the wreckage of the great financial crisis.
The GFC, yeah.
The housing market was still a disaster zone. Unemployment was high. And you're saying right now, with the stock market near record highs, the average person is defaulting on their Visa card at the same rate.
Correct. And that disconnect is exactly why the panic index is flashing red. The stock market has been floating on liquidity and, hype, particularly in AI and tech. But the foundation, the actual people buying goods and services, is rotting.
And it's not just credit cards.
No. Student loan delinquencies just hit a record-breaking 16.3%. Auto loans are in serious delinquency at 5.2%, which is just shy of the all-time record set back in 2010.
That auto loan number scares me the most. You can stop paying your credit card and maybe lose your ability to buy a new TV.
Right.
But if you stop paying your car note, they come and take your car. You can't get to work. That's a desperation move.
It is, and it tells you that the wealth effect of the stock market is essentially a myth for the bottom 50% of the country. If you're low income or if you're young, you aren't seeing your 401k go up.
Yo.
You're seeing the price of eggs and rent go up, and your wages aren't keeping pace. You're tapping out. Mortgage defaults are surging, specifically in low-income areas. The consumer has run out of runway. And the algorithms, well, they know this. They are front-running the recession that the average retail investor is ignoring.
So if I'm hearing you correctly, the stock market is essentially partying on the deck of the Titanic while the lower decks are already taking on water.
That is a very apt analogy. And the problem is, the water is starting to reach a ballroom.
And this brings us to the trigger. Because you can have a rotting foundation for a long time before the house actually collapses. You need a storm to knock it over. And looking at the calendar for this week, it feels like we are walking into a hurricane.
It is an action-packed week, to put it mildly. The immediate catalyst, the thing that could tip that first domino for the algorithms, is the January jobs report. It's releasing Thursday morning, 1 hour before the market opens.
Now, usually the jobs report is pretty standard stuff. Economists guess a number, the government releases a number, the market wiggles a bit, and we move on. But this time, the spread of expectations is weird.
It's not just weird, it's suspicious. The consensus among mainstream economists is that the U.S. economy added somewhere between, say, 66,000 and 80,000 jobs. That's a safe bet.
Okay.
But then you have the White House stepping in. Peter Navarro and other senior officials have literally waved a red flag, warning everyone to lower their expectations significantly.
Wait, the White House is preemptively telling the market it's going to be bad. That seems unusual. Usually, any administration wants to spin things positively.
Of course.
Why lower the bar?
They are managing the disaster before it happens. If the number comes out terrible and nobody expects it, the market crashes. If they warn you it's going to be terrible, maybe the market only dips. Navarro specifically said to expect a number in the 50,000 range. And the reason they're giving is fascinating. They are citing deportations as a primary driver for the labor shift.
That is a massive variable. We know immigration policy has tightened, but is that a valid economic reason for a jobs miss, or is it just political cover?
It's likely a bit of both. From a purely economic standpoint, if you remove a segment of the workforce, you naturally show lower employment numbers in the short term. But it also creates a supply shock. Less labor can mean higher wages for those who remain, which is inflationary. But right now, the market is just worried about growth. If that jobs number comes in at 50,000 or worse, below 50,000, while the market is theoretically expecting 80, you are going to see implied volatility explode.
Implied volatility. For the listener who doesn't trade options, what does that actually mean?
It means the cost of insurance goes up. It means traders expect massive swings. The options market is already pricing in movement, but a shock reading triggers those algorithmic sell programs we talked about.
The $33 billion.
And that $33 billion in selling could easily become the trigger that breaks that 67.70 floor.
And that's just Thursday morning. We also have Washington in absolute chaos. We can't seem to go a few months without a government shutdown threat.
It's clockwork at this point. We have a government shutdown looming for Saturday, February 14th. Prediction markets are currently pricing a 72% chance that the government shuts down.
So happy Valentine's Day. The government is closed.
Basically.
Does the market actually care about shutdowns anymore? It feels like we've cried wolf on this so many times.
The market cares about liquidity and data. A shutdown stops data reporting, it delays contracts, it adds sand to the gears of the economy, but more importantly, markets hate uncertainty.
Always.
If you combine a bad jobs report on Thursday with a shutdown on Saturday, you're giving investors zero reasons to hold stocks over the long weekend. They will sell just to sleep at night.
And we haven't even mentioned the geopolitical angle. You have a high-stakes meeting between Trump and Netanyahu on Wednesday regarding Iran?
Right. Any headline coming out of that meeting could spike oil prices or cause a flight to safety. Plus, we have CPI inflation data dropping on Friday.
It's a minefield.
Tuesday through Friday is just one potential explosion after another.
So let's look at the battlefield. We know the macro is ugly, the consumer is broke, we know the machines are ready to sell, we know the news cycle is dangerous. What is the chart actually telling us? You mentioned the S&P 500, the SPY is near highs, but it feels choppy.
Choppy is a polite way of saying it's struggling for direction. The S&P is less than 1% away from all-time highs, which sounds great on paper.
On paper.
But it failed to break out. There is a double top formation around the 696 level.
A double top.
It means it tried to push higher, hit a wall, fell back, tried again, and hit the same wall. That shows exhaustion. The buyers are tired.
Okay.
The resistance is at $696.50. It cannot seem to get above that. But the danger is the floor. We are watching the 692 level. If we wake up Thursday morning, the jobs report is bad, and the SPY is trading below 692 in the pre-market. That is the signal.
That's when you look out below.
Absolutely.
However, there is a fascinating divergence happening here. And this is where it gets really interesting for anyone trying to figure out where to put their money. The S&P is struggling, tech is struggling, but the Dow Jones, the boring stocks,
They're having a party. It's a classic flight to safety. The Dow Jones Industrial Average, tracked by the ticker DIA, just broke the psychological $500 level. It is hitting new all-time highs daily.
Why the Dow? Why now?
Because the Dow is filled with companies that make real things, pay dividends, and have survived for 100 years. Investors are dumping speculative tech, the AI high flyers, and running into blue-chip industrial giants.
So they're scared.
They are scared, so they're buying what they perceive as safe. They aren't leaving the market entirely. They're just hiding in the bunker.
So let's talk about that bunker. If you are a trader looking at this mess, this algo cliff, this consumer debt crisis, where is the smart money actually going? Because they aren't sitting in cash.
No, they're making moves. They're being very selective. One name that keeps popping up in the institutional flows is Pfizer, ticker PFE.
Pfizer, that hasn't been a hot stock in years. That feels like dead money.
That's exactly why it's interesting. It's been beaten down. It's in the healthcare sector, which is defensive by nature, and it has a moderate correlation to the broad market. But technically, it's testing a breakout. Traders are watching for a move above $27.75. If it clears that, the chart suggests a run up to $30. It's a value play in a growth scare market.
It's the opposite of an AI stock. It's boring, it pays a dividend, and it's cheap.
Exactly.
Yeah.
And speaking of AI stocks, look at the other side of the trade. The smart money is starting to short the semiconductor sector.
Oh, interesting.
Look at Micron and SanDisk MU and SNDK. These stocks have been crushing it for months, but they're overextended. They're starting to make lower lows. The momentum has shifted.
And what about Palantir? That's the retail favorite. Everyone loves PLTR.
Palantir is trapped, and this is where we look at the book map.
Hold on, book map. For the listener who just looks at a line chart, what are we actually looking at there?
Think of it like an X-ray of the market. A normal chart shows you where the price is. A book map shows you where the orders are waiting.
The buy and sell orders.
Exactly. It visualizes the limit orders, the walls of buyers and sellers. Right now, for Palantir, there is a massive wall of sellers at $146 and a wall of buyers at $135.
So it's a ping pong ball stuck between two paddles.
Perfect analogy. And until it breaks one of those paddles, you don't touch it. The play there is to wait for the jobs report to break the range. Don't guess. Wait for the break.
Now, I want to talk about the whale trade, because every time we look at these reports, there's always one institutional trade that makes you stop and say, whoa, that is a lot of money. And this week, it's on a ticker symbol VYX.
This is a fascinating trade. Someone put down $2.68 million on a single bet.
That is not let's see what happens money. That is conviction.
It is. They bought call options, specifically a debit spread.
Walk us through that. Why a debit spread? Why not just buy the stock or a straight call?
A debit spread allows you to cap your risk and lower your upfront cost. You buy one option and sell another at a higher price. It tells me this trader is bullish, but they're disciplined.
They're not just gambling.
No, they're executing a strategy. But here is the key. They aren't betting on next week. These options expire in December 2026.
They're buying time, years of time.
Correct. The stock, VYX, is down nearly 40% from its peak. It's been hammered. This trader is betting nearly $3 million that the bottom is in and is going to bounce back huge over the next 2 years. The potential profit is $9.8 million.
That tells me something about the mindset of the big players right now. They are terrified of the next 2 weeks, hence the selling, the defensive rotation into the Dow.
Exactly.
But they are willing to bet millions on a recovery 2 years from now.
It's short-term fear, long-term opportunism. They are buying the wreckage while everyone else is panicking about the storm.
So let's try to pull this all together, because we've thrown a lot of data at you. We have a max fear panic index. We have 33 billion in forced algorithmic selling that could balloon to 80 billion.
We have the average American defaulting on credit cards at rates we haven't seen since the Great Recession.
And a government that might shut down on Valentine's Day.
It is a convergence of structural weakness and technical triggers. The market has been ignoring the consumer distress because, the line went up, but now the machines are signaling that the party is over, and the political calendar is providing the excuse to sell.
It feels like a moment of truth for the economy.
It is. If that jobs number misses on Thursday, or if the S&P breaks that 692 floor, we aren't just looking at a red day. We're looking at a repricing of the U.S. economy. We're looking at the market finally acknowledging that the consumer is tapped out.
Here is the question I want to leave you with today. We are seeing stock market indices near all-time highs. Yet the data, the hard numbers, show the average American is defaulting on their car and their credit card at rates we associate with deep financial crises. So ask yourself, is the stock market predicting a miraculous recovery that saves those borrowers? Or is the market simply blind, driven by algorithms and liquidity while the real economy burns down around it?
That is the multi-trillion-dollar question, and I think we're about to get the answer.
Stay sharp. Thursday morning is going to be a bumpy ride. We'll be watching.